Welcome to the 13th grade. My name's Elliot Schoner. A little bit of bonus content for our investing with taxes in mind. I want to cover two concepts with you. Both of them you may not use right away. However, it is good that you know this information because you may eventually use them in the future. All right, guys. So, super interesting concept, and it kind of goes along with the other one here that you'll see somewhere on the page, which is debt is not income, and this is very very similar. However, I want you to understand that it's something that's slightly different, and I want to explain to you how the wealthy can get significantly more wealthy because when they do investments, not only when they do investments, but when they withdraw money that they'll use to actually fund their lifestyle, they will do so based on this idea that, again, debt's not income. All right. And so, again, for the most of us, we are going to go get a W-2 job. We're going to work 9 to 5. We're going to make, $20 an hour. We're going to get some sort of income. And then we're going to be taxed on that income. And then we're going to send it, send it to the IRS or whatever. The last concept we just talked about, debt is not income. We talked about if you purchase a property, for 200,000 and it goes up in value for 400,000. If you sold that property, the 200,000 is capital gains. It's a taxable event. You've actually made profit, and so you'll be taxed on that capital gains. However, if I didn't sell that property and I took debt out on it, and then I used that debt as kind of like income, and then I deployed that into other resources, I wouldn't be taxed on any of that. And essentially, it would be my assets purchasing my assets. And that can be very, very powerful because remember, taxes is kind of the number one robber of our money, right? If we put money into an IRA or something like that, and we're looking for 6 to 10% return, if I sold my house and I was taxed 15% on it, well, I'm getting 15% in taxes right off the rip, right? And so that's a big, big downside. And so if I get 200 grand, I'm minusing 15%, like, man, that sucks. I'd rather have the full 200 and then deploy that and get, my 8 to 10% return off the full 200, not 200 minus the 15% taxes. So the second one, and this actually comes up almost every single year. It's always during election year, but it is this idea of selling, or I'm sorry, of taxing unrealized value. Okay, so what I'll say to you is unrealized value is not income. All right. And so this is kind of very, very similar. Man, very famous for this, all over the news as it is right now in 2025 is Elon Musk, right? But it's not just necessarily Elon Musk, but we'll use him because, everyone knows who that is. Any CEO, Jeff Bezos, Zuckerberg, they all use the skill. So, or this trick, not trick, but it is what it is. Loophole, whatever. If a CEO was going to take a job for a company, and their income that they were going to receive, so they get a contract, they get an offer, just like we would get an offer. They get an offer for $20 million a year to run the Coca-Cola company. Or in this case, I think Elon Musk got like $40 billion a year if you did certain things running the Tesla, right? They'll actually get an offer just the same. However, within that offer, it might say something like $20 million is your package. However, we are going to pay that off we're going to pay that to you in stock. So every quarter, every year, every however period of time, you're just going to be issued stock. Okay. Now, this could be potentially kind of risky for a CEO because let's say, for example, or anybody in a company, let's say they issue you stock for your $20 million in income, and they're issuing it to you based on the idea that share value, the price per share is $100. Let's say that the company's not going very well, and that $100 decreases, and now the company's only worth $50. Well, you're still being paid the 20 million based on the $100 per share, if all of a sudden these shares that you have goes down in value and it's only worth, say, again, half of that, well, you just lost your income of 20 million. Now you only made 10 million. Hopefully that makes sense, right? On the flip side, if the CEO does a really good job and they're issued $20 million in stock, they could then, let's say the stock goes up in value, so it's not 100 anymore, it's 150. Well, their income isn't 20 million, it's now 30 million. So hopefully that makes sense. Some CEOs will do a variance. Well, they'll take some just like regular income, so just like a regular paycheck, like you and I would get, and sometimes they'll go, I'll do some of that, and I'll do some of it can be stock options. However, there's a lot of CEOs that were like, I'll take a salary of $1 and everything else that I get, all the compensation that I get is going to be tied to the stock price. And it can seem like, oh, that's a really cool thing for a CEO to do because they're really tying their pay based on the performance that they have. Like they're just not going to get paid even if they tank the company. They really feel pretty good about the company. They think they can turn around the company, and they'll tie all their pay to income. Well, the reason why they do that is because remember what I said to you, unless you're getting a check, like you're actually going to disperse money, it's not income. And so $20 million times what a tax bracket might be for someone like Elon Musk that was living in California at some time. I mean, you're talking about the highest marginal tax bracket of what was it, 35%? It's been as much as 40%. Hell, it's been as much as 78% or 90% in our history, right? If you go back like, several years. They're getting a big chunk of that taken out in federal income tax and state income tax. So that's not a good thing, whatsoever. So what they might do is they might say, okay, well, I'm going to just do the $1. You give me $20 million in stock, right? And then because they're not getting that in income, they now have $20 million in value. But it's kind of like let's say it's unrealized value is potential value, right? And again, unrealized value is a really great way to think about that because the stock can go up and down. So as a government, we've made the decision. We're saying we're not going to go in and tell Elon Musk like, oh, you got paid $20 million in stock, so you owe 40% of the 20 million. Now, this is a discussion that oftentimes comes up around election season because people like to pin the rich against the poor because if we're divided, we're easily conquered and whatever. However, the reason why that comes up is because what these guys will do is they'll say, again, I'll take a $1 salary. I'll take the $20 million in stock options, or I'll take the $20 million in stock as a pay. Hopefully the stock has gone up in value as well. So that 20 million is going to continue to increase, right? But what they'll do is instead of like selling some of that stock per se, and then actually coming in and then getting taxed on that percentage to the point of 30, 40, 50%, right? What they do is they go to a bank or they go to basically, it's usually, private lenders, that type of thing. And they'll say, hey, I have $20 million in stock. I would like to take a loan against my stock that I own of $5 million, right? And so, in a sense, they're getting 5 million, but it's not income because it's debt. So very, very similar to the home or the property, right? Now, when you have a property that goes up in value, it's for the most part, it's pretty self in stone. Like houses don't fluctuate a whole lot. Stock can actually fluctuate a great deal, right? A little bit more risky. Again, either way, unrealized gains, they didn't necessarily sell it. So there's not because they didn't sell it, they didn't receive income. Because they didn't receive income, they're not getting taxed on it. Instead, they're going to go get a loan and they may pay that loan back at, let's say, I don't know, 3% or 4%, whatever it is, right? And what do they pledge against that loan? Because it is actually a secured loan. They're pledging the actual stock shares themselves. So for whatever reason, the stock completely tanked. Well, the lender could actually come in and say, hey, the stock's going down. We don't feel so good. We're actually going to liquidate some of the shares that you've pledged because we need to get paid back that 5,000 or 5 million. So what happens? How does that happen? How do CEOs take out money and take out loans and then basically use that in for income? Well, here's the thing. If you're a CEO and you're making, let's say, $20 million a year, right? well, I'm making $20 million and then I take five, and then I make $20 million and I take five, and then make $20 million and I take five, right? And so they're accumulating hundreds of millions of dollars, obviously, in stock, and then they're starting to loan against it. Will they ever really pay the $5 million loan back? And the answer to that question is no. Of course, of course not. There's no necessarily need to, or if they do, they're going to pay it back with another actual loan. Because what happens is next year they're going to get more money. And so they could use that money to pay back the original $5 million loan, right? And then they could actually just take out more money, right? And keeping also in mind that hopefully they're doing a good job in that value, in that stock is going up in value. So imagine you had, let's say for easy numbers, um, $20 million in actual stock, and you knew that that stock was going up about 10% a year. $20 million times 10%, that person's making, or that CEO is making $2 million a year off just the stock sitting there because it keeps going up every single year. So they could actually go and say, I'm just going to take out $2 million a year, live off of that, and I'll leave basically the 20 million in there. And then whatever they make, they could kind of just pay that off with the amount that they get. So hopefully that makes sense. So the stock could actually go up in value quicker than the money that they're actually taking out. So it's kind of a game. They keep taking out money. The debt comes due. They can take out more debt to pay off that debt. But because they keep, getting more stock, and because the value keeps going up, they never really have a big issue. Again, they're using debt to fund their lifestyle, or they're using debt to do other things. When Elon Musk recently bought Twitter, right? How did he do that? Well, yeah, he sold a little bit, but he actually pledged a lot of the actual shares to get the equity as a loan to go buy Twitter. So he bought Twitter with debt, debt on debt. If he would have taken all of those shares and had to sell them to then go buy Twitter, one, Tesla would have completely tanked, and then he may not even necessarily have the money because he's going to be taxed so much on that. So again, I'll just show this to you. One of the reasons why it's structured this way, and why it's never ever going to be changed, and why we will never, if you're listening to politicians, well, we'll never tax unrealized gains, is if you remember back as a great example, when Elon Musk was going to go buy Twitter, the stock drastically went down. And the why? Because he actually did have to sell a certain portion of a stock. When a CEO comes out and says, "Hey, I'm going to sell, you know, $10 million of my stock," it can be a big red flag to anybody that is also a shareholder in the company, because they're thinking, well, maybe the CEO knows something that we don't know. Is he selling a stock because he thinks the value of the stock's going to go down? So he's trying to sell before the value of the stock goes down? Or like, what is it? And so there's whole groups of people that track sort of inside traders, like who's buying a lot of stock, who's selling a lot of stock, what CEOs are buying and selling, what VPs in the company are buying and selling. And so they'll track these companies, and it'll be indication of like the CEO selling the stock and the VP selling the stock and a bunch of people are selling the stock. It might be an indication that you should sell the stock. You should get out of it. If Elon sold, let's say, I think he bought Twitter for like $40 billion or something like that. If he sold $40 billion of Tesla stock, it would completely tank. It would completely tank the stock. And so like every time he sells it, the stock goes down. So then he's going to sell more of it because the stock is of less value. So then he's going to sell more of it, and kind of it would just tank the stock, right? And then everyone else would see the stock's going to go down, and then everyone else would do it. It would just kind of completely crash the stock. And who owns stock other than just major big CEOs and people like that? People like you and I, right? They're in our 401ks, they're in our IRA, they're in the index funds. So we don't want CEOs, even if they have, you know, $30 billion in stock or like in their own company, we don't want them necessarily just liquidating it. I'd much rather have them take a loan against it and live off the money of the loan and just leave that stock alone, because it's going to be good for everyone. So again, I know it's probably a little bit boring, to listen to. It's a different kind of an idea, not something that you and I necessarily will be doing anytime in the future, but it is something I want you to understand, because it is a tool that the wealthy use. It is potentially something you could use in the future, but again, we just want you to know about it. So as you start to see the discussions and people are talking about unrealized gains and what's capital gains and all of that, you can kind of understand. And more so, the main point is I want you to be thinking about what can you do, or how can you structure your sort of financial journey into how you can restructure your properties, or you can restructure your asset to pull the equity out via debt versus actual taxable event. Because if you are paying, because you will generate income, you will be sort of, the higher end. And if you are going to have to pay 30 or 40% on like sort of income, how do you avoid that? You can do that through, again, taking out debt on equity that you already have. So hopefully that makes sense. And of course, there is some additional content on manipulate.com. So if you are a little bit confused on that, we will link to some other better explanations of that. And of course, if you have not, and this is one of the first videos you've seen, please go back and watch the whole entire course because this can make a lot more sense to you. Until next time.